Hello everyone, the stock market attempted a comeback from its recent slump early last week by clocking a best 2-day rally since the pandemic. But then, a strong employment report on Friday brought the market down again. In this video, I will share why a good news such as good employment data is causing the market to fall. Also, I will cover the key events to look out for in the next few weeks that could potentially set the tone of the stock market for the last quarter of this year. So stay tuned to find out more. The stock market got off a super strong start last week as major indices rallied with huge gains, perhaps because various reports show that the economy is slowing down and investors might have thought that the Fed hawkinish has reached a peak. But sadly, the week ended rather flat as the stock market plunged on Friday. This latest fall was likely due to a strong labour market reported. So on Friday, US monthly employment report showed that the job growth is still very strong despite many big companies are laying off people or freezing their headcount and hiring. So interestingly, this sort of good news is classified as bad news in today's context because it dashes any hopes that the Federal Reserve will pivot or slow down their aggressive rate hikes. In short, the strong employment report is not what the market wants to see. This may sound bizarre as it seems like people are hoping for others to lose their jobs and for the nation's unemployment rate to go up. As we welcome a new week, all eyes will now be on the Consumer Price Index CPI data again, which is set to be released on 13 October. To recap, a hotter than expected data in August has caused a massive sell-off last month, and I think if a similar type of data were to appear again, the sell-off could just continue. To add on, Federal Reserve will also be releasing September's meeting minutes on the same day. Okay, other than CPI number and Federal Reserve's interest rate hike, the upcoming earnings reports by the banks and mega cap companies could also be a potential minefield. In case you're not aware, we already had quite a number of companies giving caveat that their earnings and forecasts will be reduced, with the latest one coming from AMD. As a result of AMD's news, stocks of various companies in the chip industry such as Nvidia, TSMC, Global Foundries all fell. The message here is, can you see that ripple effect? And this could happen to any of the other industries, be it online advertising, electric vehicle, streaming service, e-commerce, etc. My view is that some of the difficult business conditions or negative impacts brought about by high interest rate and weak macro environment have not been priced into the stock market yet. Therefore, investors should keep their seatbelts buckled and brace for potential impacts as companies report their earnings. On the other hand, despite the various bearish factors and sentiment, from a technical perspective, when the market is severely oversold or super bearish, there could be some form of rebound here and there, something similar to the one we had early last week. So traders have to be mindful of this if you intend to trade heavily on put options. Okay, before I touch on the technical segment, I thought to include this portion on how to interpret my technical analysis content. In my videos, I usually paint both the up and downside of SPY or the individual stocks that I usually cover. And some viewers may feel that it seems like I am saying these stocks will either go up or go down. That's equivalent to not saying anything. And I don't think you would want to watch my video for this type of statement, right? Therefore, to clarify, or if you have been following my videos closely, you will realize that I always keep my mind open and prepare myself for both up and downsides. So here's how I work. I don't like to predict the market movement in the short term, such as whether it's going up or down the next day or next week, or at least I try not to. As always shared, I let the market makers tell me which way they want to go, up or down, and then I follow suit. This is why I usually cover both the upside and downside in my videos, with conditions. And when these conditions of that particular direction are met, then the probability of that direction will be higher. And to be more specific, fundamentally, I look at support levels on the downside and resistance levels on the upside, and I combine this info with other indicators or signals. And to be even more specific, here's an example. Previously, I mentioned that SPY printed a bearish engulfing candlestick and a bearish inverted cup and handle pattern on the weekly chart. And if it doesn't rebound from that strong green support trend line, we could retest June's low of 360. So let's break that down. In this case, the signals are the two bearish candlesticks, and one of them, the cup and handle, is a powerful one, which I have also shared. The condition is SPY needs to rebound off that support line, which it didn't. With the signals and conditions met, hence the probability of it sliding down to June's low is high. And there we had it, SPY broke June's 360 and created a new 52-week low. To also share, I don't just use those candlesticks and support lines. In fact, it is recommended for investors or traders to include other indicators, oscillators and signals if possible, which I try to as well, but it's hard for me to include everything here. With all being said, a quick disclaimer, even if the so-called prerequisites or conditions were fulfilled and the probability of the outcome increases, we could still be wrong. I mean, nobody has a crystal ball, so we can only do our best to go with the option with higher probability. Okay, if you have learned something till this point, I hope you can help me with the like and subscribe buttons and also leave a comment below. This will really help with the YouTube's algorithm so that this video can reach out to more people and will definitely keep me going. Thank you. Alright, let's have a look at SPY. For newer investors, just to share, SPY pretty much represents the broader market. So usually I will spend more time explaining this chart as it can give us some clues on the weakness or strength of the entire stock market. Anyway, very interesting chart here and very textbook stuff too. Let's dissect them. Firstly, SPY has hit the resistance level marked by the red dotted downward trend line that I have drawn and got rejected on 3 occasions. So what does this mean? It means sellers are stepping in, it means the market is still weak, it also means I wouldn't buy call if it cannot even break above this trend line. This is in fact quite a textbook stuff which I think could be useful for newer investors or traders. Okay, so that's the resistance on the upside. So now let's have a look at the support on the downside. Check out that yellow support line, which is one of the Fibonacci retracement levels. Previously I've mentioned that this is one big crucial support level. And once again, textbook stuff, check out how SPY rebounded off this area on 6 trading days, with one day sitting just below it. But the very next day, a green candle was immediately printed, which means there were still buyers stepping in to defend this area. Now let us zoom out of the chart and we can see the next meaningful support is at 344. And if we get there, it means the market will be really bloody and we will also be creating a new 52-week low. Again, zoom out a little bit more, you will notice there is this descending triangle. To share, a descending triangle is a bearish pattern, and as we approach the end of the triangle, there will usually be a breakout. Since it's a bearish pattern, then based on textbook definition, it should break downwards. But, yes, there's a but. One should not rely only on a simple textbook answer or pattern, so do check out other indicators or signals too. Interestingly, when I look at the weekly chart, it shows a gravestone doji candlestick. This candlestick, if you recall, it appeared on Tesla stock which I highlighted just last weekend when Tesla closed at 265. Guess what? Tesla is currently at 223 now. So SPY does look bearish at the moment. But of course, as shared earlier, we need to be prepared for the upside or any potential mini rally. Say if next week's CPI gives us some good news, SPY could still bounce up. When that happens, let's go back to the red resistance line again. Basically, if it breaks and stay above that, we could then visit the next heavy resistance at 387. My view at the moment is that it will be very tough to break above these 2 resistance levels. Next, we have Apple. Apple tried to break above 61.8 Fibonacci level of $146 on 3 occasions last week, but failed to do so. So for the upcoming week, this level will once again act as a resistance level, after which it will be 152 and 158. Personally, I am of the view that 158 is the biggest resistance at the moment and I foresee sellers to come in quite aggressively at this level. Reason being, that is where the 50 and 200 moving averages and 38.2 Fibonacci level are. On the downside, as shared previously, I don't see much support, so unless CPI turns out really good or if Apple reports very good earnings on 27 October, I am of the view that we could head towards low 130s and even retest June's low. Well, I could be wrong. Moving on to Tesla, in my last video I shared that there was a bearish gravestone doji candlestick when it was at 265, and there you go, Tesla fell by more than 40 points to 220s. And this week I spotted something bearish again, and that is Tesla has broken the support trend line that stretches from June's low till last week. So right now, watch if buyers will start stepping in to push it back up above the trend line or not. Otherwise, there is some level of probability that we will head towards June's low. Anyway, some words of caution. If you wish to short Tesla, you have to be very careful because Tesla relief rallies can be relatively fierce. So the last thing you want is to short at the wrong time, Tesla bounces up and you get trapped at the bottom. On the upside, resistance is around 255. Do also note that there is a gap between 255 to 262. So market makers could potentially bring this stock up to fill the gap before dumping it again. Next, Microsoft. I like how the candlestick sits so nicely along the resistance line that I have drawn at around 240. You can see that it tested the line on at least 8 trading days, gap up and then gap down nicely below the line again. Anyway, I am expecting some form of resistance or selling when Microsoft hits this line again or when it goes up to fill that gap. At the moment, anything below 260 is bearish to me. On the downside, it is almost reaching the consolidation zone of 200 to 220s that I have first highlighted many months ago. How amazing that Microsoft has fallen from 270s, 280s to 230s now. Day by day, it looks like the probability of hitting the low 200s consolidation zone is getting higher, which also means a new 52-week low could come into play. Personally, I am hoping to buy more stocks in this area. Okay, moving on. Google. Resistance levels are at 105, 110 and 120. But I think 120 is a little far-fetched at this point. Google might just chop around the current range until their earnings are out, or maybe when there are good or bad news related to the online ad space, which could then potentially trigger some big movements for Google. On the downside, the next support level is at 90, with gaps at sub-80s waiting to be filled. In my view, Google's price is very attractive if we ever go to 80s range. On a side note, sharing my basic whale strategy for option traders. On 30th September, I have deliberately gotten the assignment of 100 Google shares from my option trade, with $100 as the strike price. Shortly after the assignment, I sold a covered call, which is a bearish move, at $105 strike price. Yes, if Google reports good earnings, the price could break above the support level of 105. And if that happens and if my stocks get caught away, I am okay with it because I would have earned $500 on the stock gain with additional $238 premium that I have collected when I wrote this call contract. Well, for a small option trader like me, $738 or aka 1,000 Singapore dollars is not too shabby for additional income for this month, isn't it? So when the stocks get caught away, I will sell a fresh put contract to restart this whale strategy and collect more premiums as I wait for another round of assignment again. On the other hand, if Google remains below $105, my call contract will expire worthless and I get to keep the 238 premium that I have collected at the start. Then I will continue to sell covered call to milk as much premium as possible. Some end thoughts from me. Personally, I have some concerns about this bear market, and my biggest one is actually not having enough cash. To me, it's like fire sales everywhere in the stock market, and I am like trying to buy all the stocks on my watch list. I'm doing so because I believe bear markets present the biggest opportunity for long-term investors to increase their portfolio by 2-fold or 3-fold in years to come. And bear market is often the period where the wealth gets transferred from those who can't handle volatility to those who can. But of course, I know there are investors who are worried or anxious over the weak market and may want to opt for safer options such as government bonds or fixed deposit from the banks, which I think is absolutely okay. Feel free to stay by the sidelines if that makes you sleep better at night. Remember, health is always more important than wealth. Anyway, overall, my view of the market is still bearish, and it has always been like this since the first quarter of the year. With all these weak macro factors still in play, I am of the view that investors should be prepared for a very choppy last quarter of 2022, and that this weak market will likely drag into 2023. As I have been emphasizing, any rallies during this period will likely not sustain. But just to put it out there, I am not a permanent bear. In fact, I believe the market will go up in the long run, and that is the reason why I am busy buying shares right now. It's just that there is almost no reason for me to be bullish as we are in one of the worst macro environments in many years. I will be bullish when macros improve, when Fed pivots, and when the technical charts show me something different. Lastly, I just wanted to say don't fight the Fed. To put it simply, if they are printing money and lowering interest rate, which is good for the stock market, it is okay to be bullish. Right now, they are removing money from the economy and raising interest rate, which is bad for the stock market in general, and hence you shouldn't fight or go against them by being bullish. Alright, that's all for this video. If you have found some value in my video, please comment below. Do remember to hit the like and subscribe buttons too. Thank you.